Maverick traders, welcome out to your market roundup, March 14th, 2023. Plenty to talk about. Boy, is there a lot going on in the markets, so let's get to it. As always, we want to look at the markets from a top-down perspective, and I'm going to argue it's not as bad as it might seem. So the Dow, the S&P, and the NASDAQ, Russell, they all bounced back today. Dow was the laggard, up only about 1%. Everything else in the neighborhood of 2%. Oil got hit, down 4.5%. Gold basically sideways on the day. Advancers versus decliners, 70% of stocks advancing today. And the market's decidedly bearish, right? 78% of stocks below the 50 MA. So why am I saying it's not as bad as it seems? Well, the reason is really because of the difference between expectations and reality. The fears of what's unknown and so on versus the trade-offs of what's probably going to come. And we have to figure out the future. We have to figure out Fed policy and all these sorts of things. CPI came in this morning at 0.4 month over month, a 6% year over year number. That's too high. Clearly, the Fed was on target to raise rates by 50 basis points. They're probably going to raise by less than that. The US dollar's rolling over because of all this chaos and confusion in the banking sector. So let's try to make sense of this together. I pulled up a chart here of SHY. This is an ETF that just tracks 1 to 3 year treasury bonds. Now, a couple of important things. When bond prices are going up, that means yields are going down. So what we saw was that the bond market was getting hammered for a number of months in a row. Bond prices falling, yields going up, right, during that period of time. This created some unintended consequences, some collateral damage. You had banks like SVB and some of these banks that were in the wrong duration, and they own longer term treasuries, and the prices were going down and the yields were going up. Now, that's not a problem if you can hold through to the end of its life, right? Through the duration until they hit maturity. It's not that big a deal because you're going to get that money paid back to you and you've made loans against it and all is fine. It becomes a problem when you have to sell your bonds into the declines, because as soon as you sell, now you're selling at the market prices and you're taking a big loss on that bond position. And so when you have people coming to the bank and saying, we want our money back, well, the bank has to come up with the money from somewhere. And they had to sell a lot of these assets they own, but were down in the dumps on them. And they were selling them at a loss, which means they're locking in really bad prices. They're not able to hold to maturity. They're just basically sending this money back. And having more leverage in the system is what banks are all about, and it's not that big a deal if everybody doesn't want their money back at the same time. It's kind of like a gym membership. The gym says we can sell way more memberships than we have equipment for because they're all not going to come at the same time. It becomes a major problem if everyone shows up at the exact same time wanting to use the dumbbells or something. Then you have chaos and confusion, and there's just not enough of the equipment for all of these memberships. Well, that's kind of what happened. They had to run on the bank. They had to sell assets. It basically liquidated their portfolios and created those losses that wiped them out. And there's still some risk to other banks out there, but this is not a systemic problem. This is not something that's widespread and every bank has that problem and so on. This is more focused on, I think SVB is a very good example, Silicon Valley, things that are operating in the crypto markets, that we're doing a lot of operations and things that have gone down a lot in value, and they're in a worse spot because of that. So now they're in a situation where basically they've been wiped out and everyone's looking around going, well, where's the next shoe to drop? Who can we trust? Can we do business with these other banks and so on? But look at the market's response. The response is one that's kind of weird. Because there's a flight to safety, people are buying these bonds, which actually relieves a lot of the stress in the markets. The 2-year bond went up dramatically. The yield fell by 1% in a day. That's unheard of. And that eliminates a lot of the stress that the banking system and some of these banks that were in trouble actually had. You see the US dollar has fallen over. Why is the US dollar going down? Well, because they're going to print more money and backstop and so on. So it's one of they're turning back on the printing presses. There's a Fed put under the markets. A lot of what was causing the problems, it just so happens that because the flight to safety is one that relieves this particular problem, all of these things kind of work in a way that's more bullish. And I haven't heard anyone else argue this. This is my own thesis, but as I'm checking the boxes, I said, you know what? That's more bullish for stocks. That's more bullish. This is more bullish. Dollar's going down. That's more bullish. Fed's going to cut or hike rates by less. That's bullish. The peak Fed funds rate is probably going to be lower than expected before. That's bullish, etc., etc. So I don't think that this is a catastrophic event for the markets. Now, I might be wrong about that. There might be more volatility, but just kind of speaking through the fundamentals and the metrics and so on, this relieved a lot of the stress and a lot of the pain that's there in the markets, I believe. And so when I look at this chart of the S&P, not a great chart below the short-term moving averages, which are rolling over, but this looks like a classic exhaustion. Highest volume bar we can see on the chart at the lows after an extended drop. This to me is the start of the race down. This to me is a sprint for the finish line. The sellers have very likely been mostly exhausted. I wouldn't be surprised if there's a little chop, but I think the next move is actually up, and the QQQ chart is more bullish. And this is a big change for me. I mean, I said last week, I've said for the last couple of weeks, I'm just outright bearish. I thought we were going to go lower, but you trade the market that's in front of you, and sometimes things change. This is a bullish chart in the NASDAQ. If we break above this, this is a classic chart pattern where you have a bull flag. Look at the flagpole and then the flag waving in the wind. It's a deep correction, and we may go up and out from here. There are sectors that make more sense towards buying than others. And I think the NASDAQ, think about the things that are helped most by lower interest rates, and that's the area of focus on the upside. So it makes sense to me that QQQ is rallying, that IWM is rallying, that some of these areas of the market that maybe are more growth oriented and so forth have bounced harder and probably will continue to see some rotation there. So I know if you went out and talked to 100 people, they'd all say that this is terrible and horrible for the markets and so on. Markets are counterintuitive, and I actually think that this might have set a low for the markets for a period of time. That, to me, again, looks like an exhaustion flush. I took profits on bearish trades the last couple of days. I continue to adjust where I went from quite bearish, and over this weekend really had a change of heart in my outlook on markets and expectations, and have been looking at taking profits on bearish trades, adding more bulls, and so on. Today it was a good day in terms of bounce back. Again, there's going to be a little tug of war down here. I think it's a blessing if you get a little sell-off tomorrow or the next day to maybe consider at least taking some of those bearish trades off and seeing if we've set a temporary bottom here. Financials, they're right in the eye of the storm. I think you can look elsewhere potentially, but nevertheless, the market as a whole may come back. So the markets, again, technically don't look so good unless you're looking at this as kind of an exhaustion low, in which case we kind of consolidate for a time and should rebound out of this a bit further. On the bullish and bearish list, I've got mostly tech, well, all tech it looks like on the bull list, and then a mix on the bear. So a few names that stand out to me: AMD on the bullish side, consolidated little mini type of cup and handle dynamic. Ascending triangle is probably what it is more than a cup and handle. See how the lows are going higher and the highs have flattened out. Sure seems like it wants to move up and out from here. Next on the list, we've got Meta, formerly known as Facebook. Again, just kind of that ascending triangle, cup and handle type of pattern, starting to accelerate to the upside. And maybe my favorite chart is Microsoft, where it's had a little deeper pullback. This one looks like we're poised to move back up towards the top end of that range. And again, it might have little pullbacks and whatnot, but this should be kind of a rounded bottom here. And I suspect from 260 up there to about 275-ish in the near term. On the bearish side, I've got Costco. Nothing special about this other than it looks like something that should continue to really work its way to the downside. We had the exhaustion low and it's consolidated in here, but if this fails right up against these levels, maybe some period of underperformance in Costco. In phase energy, I had this one on the list last week and it's come down some. I still suspect that that one should be an underperformer here in the near term. And last but not least, XME, which is a metals and mining ETF. Again, looks like as you rebound, you have a lot of selling on the way down. You may get less of a bounce on lighter volume. And I'm really looking at this on the rally, not shorting in the near term, but shorting more to the upside. And I have to say, of the difference in trades, I'm more excited about the upside trades this week, which is a big change for me from the past couple of weeks. So I think that really last 2 days have been a bearish take profit opportunity. Yesterday, today, you want to be scaling some of those down, at least getting a little less bearish. I would phrase it this way. If you were positioned bearishly, what were you positioned for? What were you hoping to accomplish? If you're going to take profits early, if that's part of your trading system, then yesterday was a perfect opportunity. There's negativity, the market's selling off, high volume sell-offs and so forth, and signs of just capitulation, kind of people throwing in the towel and saying too much risk, I'm too nervous, get me out. And that's usually a time to take profits on bearish positions. We've got the PPI out tomorrow, and then on earnings, we've got Adobe, Dollar General, Five, FedEx, a few companies reporting, but we're really winding down on the earnings side. Hope you enjoyed the market roundup today. Have a great rest of your week, and we'll see you next time. Goodbye, everyone.